Oh, Sam, guy is going to retire in 2 years, can't stay in Bay Area. What do you suggest? Move to Puerto Rico? Now, Bay Area has its own charm. So I know it is super expensive to live in Bay Area, but and I realized when I made a trip last week to East Coast, and I was wondering, damn, what are we paying here for Bay Area? But I guess it has its own charm, man. All right, so we got a Tim and Anura. It looks like you guys know each other
Oh,
from some other.
Vivek,
Yeah,
Vivek,
yes, Sam.
can I pay for you to teach him how to invest his money? He means a lot to me.
No, I'm not doing it for payment. So as long as you keep learning, I think that's my tuition fee.
Well, no, I really want him to learn because he's been helping me out for the past couple of months. But can I pay you to teach him how to invest?
Okay, I mean, I'm ready to help if someone needs. So yeah, we can talk about it.
Can you give me a fee schedule? He's that
So,
important.
so let's take it offline because I don't do it for kind of
Okay.
a fee. So if it's like a one-time session, I need to talk to someone, I need to help them out. Yeah, I'll do that for free unless I realize, hey, he needs some regular help, etc. So you're talking about your friend? Okay. Yeah, okay. So yeah, maybe I can just talk to him first session before before we figure out what needs to be done. Because I don't do this for free. Anyway, so all right.
Hey Vivek, yeah. So I've met Tim before in another meetup, so that's why we were just saying hi.
Cool. This is a small world anyway.
Yeah.
And I realized it today morning. Those who are from, let me see how many people do we have anyone from Bay Area joined yet?
Yeah, I'm from Bay Area.
Oh, so you might recognize this place. So today morning, I went for a hike.
Oh, Mission Peak.
Mission Peak. Yeah, you got it.
And
I went for a hike with my friends, so we were like a bunch of friends. We all went together. But
but this thing was stolen, like somebody.
yeah, this was stolen. It's been restored now.
Oh wow, okay.
Okay, so that's not the great part. So the reason why I brought this up is like world is small, right? So this photo with my friends. So there was a long queue to take the photo with this specific pole. Sorry guys, this is Bay Area specific stuff, but I'll get to the point. And there was a long queue for this, so we were waiting in queue, and I told my friends that, hey, I can't stay here longer. I need to head back because I have to be home by 10 o'clock for the session. So my friends are still there. But anyway, so I was waiting in a queue. There was one gentleman who was taking pictures of his group. And then once he was done, I called him. I'm like, hey, can you take our picture? And I handed my phone. He turned around and he says, Vivek? I'm like, what? I'm like, what? He says, and then he like, yeah, I've attended your option sessions. I learned a lot. So thank you for doing it. I mean, that's like a world is so small, right? Off the peak, on the Mission Peak, I meet someone, I ask them to take my photo, and that turned out to be, one of a person from our group. I'm like, whoa, world is too small. So yeah, small world. Yeah, exactly. So that was fun. So we had fun today morning. I guess maybe I can do it on Saturday, but I had to get up early morning, like 5 a.m. because it's like almost half an hour from my place to Mission Peak. To the parking, and then coming back is another half an hour. And it takes around 2.5 hours to do the hike. But I'm refreshed. I came, made some smoothie. I'm on and all set for today's discussion. So good start of the day for me. We had some fun today. What did you guys do for fun this week? Anything to share before we get into investing and other stuff? And is any new stuff? Anything new learnings?
Yeah, I've been exploring the OBV indicator lately, so which looks really interesting. So
OBB.
OBV, yeah, on balance volume.
Okay. Oh, okay. I'm not a yeah. So I haven't looked into any new indicators, etc. I have some set of indicators that I've used for few years,
Hmm.
and that's what I continue to use. That just tell me, whether I should do an option trade or maybe I can wait a little bit, etc. Those are not my, or what I would say, the major decision maker, but yeah, it helps in confirming the decision. Anyway, but OBB. So what we're going to talk today, I think two topics that I have, the big ones, which is one of them came from, one is around the Ethereum price target. And I know we're talking about crypto, but now the crypto and traditional finance are merging, guys. So whether you like it or not, the day may not be far away when in your own retirement account, you'll start to have exposure to crypto, right? In Canada, it is already happening. So from a Fidelity's conservative model portfolio has got allocation to Bitcoin. So I think it is but natural that we should talk about what's happening in that world. I don't get into the details of the individual projects or the tech details in this meeting, but I think as far as it's as long as it's related to investing or what's happening, I think I do want to bring up in these sessions. So we'll talk about there's VanEck. You guys probably know VanEck is a big ETF issuer. They already have like SMH, right? The big semiconductor ETF, which is making all the news. I mean, it's hitting like all-time highs, right? And all thanks to the craziness from NVIDIA, SMH is now 264. This is VanEck Semiconductor ETF. So VanEck have been around for some time, and now I saw their Ethereum price target. I think the numbers probably you can calibrate the numbers based on your own understanding of the ecosystem. Numbers are not important. What's important is the thought process and the things that have been considered while coming up with the estimate. So I do want to get through that report of Ethereum. And like I said, it's some price targets are crazy. When I looked at it, I'm like, oh, okay, come on. What are you drinking? Or like for ARKK, what ARKK analysts, what are you guys smoking? Secondly, looking at a message from Ramesh saying ETF rebalancing affected the market. There is a big rebalancing which is happening in an ETF called XLF. So do want to talk about it. And the offshoot of that is the second topic, which is how do you diversify a concentrated portfolio and without paying taxes. So this came up from a discussion, I think it was last week or maybe earlier this week. One of my friend who's a CFO in a company, so he reached out to me and he wanted to get some confirmation around some discussions on options. So I asked him, like, what brings you to options? And so what he told me that he's been in some companies for more than a decade, and he had a lot of stock options. So obviously his portfolio is very concentrated, and he's looking to diversify. And I guess another friend told him something about covered call, and he said, I've never done options in my life, even though as a CFO, he was responsible for managing millions of dollars of options for his company, like stock options, but he personally, he has never done options. And he knew that, I'm active on this. So during that discussion, I asked him, what are you doing for rest of your portfolio? He told me that one of his financial advisor gave him an option to kind of invest in a fund, which is a Diversify, but then he doesn't have to sell his holdings to buy that fund. So there is no capital gain. That was very interesting idea for me. And then I started digging deeper into it. And then I realized that this whole ETF rebalancing, something I saw in ETF rebalancing that piqued my interest. There was, and these diversifying your concentrated portfolio, they're kind of interrelated. So I thought I'll talk both of them. So those are the two main topics. And as always, we'll bring something for our investing mindset and maybe any other stock that you guys want to talk about. I don't have anything right now prepared to do a deep dive into any stock. I mean, last stock we did a deep dive was Hims and Hers. I don't have anything else unless, you guys have a stock in mind and maybe we can do it next week. Right. What else? Sounds good. Anything else you have in mind? Any other questions? Anyone here for the first time?
Yeah, Vivek, it's my first time, Anurag here.
Anurag, it's the first time. Why your voice sounds a little familiar? Maybe there is a different. Maybe I think I got confused maybe with Aditya. My apologies. So I think Aditya has been here before. Maybe you're joining it for the first time. So what brings you here?
So yeah, I've been looking into investing and trading for last couple of years, and I've been looking to make new friends in the community, be a part of the community. So that's why I started like joining different groups.
Okay.
So yeah, it's always good to gain some knowledge, understand perspective of others on the market and different stocks. So yeah, it's that's why I just wanted to join, gain some knowledge, make some friends. Yeah.
Yeah, cool. Yeah, investing otherwise becomes a lonely profession. So it's
Yeah,
a good to have a community to bounce some ideas off. Okay. I'm not a kind of a trader. I'm basically for me, I'm a long-term investor, but I use options to stay invested. So I am not the one who's looking to profit for next 1 week or a month or a year, etc. So that's about me. But you will see me doing a lot of option trades because either reduce the cost basis, essentially reduce the cost basis or reduce the risk in portfolio. So that's my style. But there are a few people who are kind of focused on day trading as well. So if you have any questions around that, others people can help us. I mean, that's the beauty of having a community wherein we have a different people with a different skill sets and we can help out each other. Tim says he is here for the first time as well. What brings you here, Tim?
Well, actually, a lot like what our previous speaker talked about. I'm still looking for a good long-term community to be a part of. There used to be several excellent option communities here in the Bay Area, but those got pretty much wiped out by the coronavirus issue. So they haven't restarted.
Okay.
So we used to have a Monday meeting that we went to at 2:00 where everybody threw a body on the table and then started just to dissect it. It was a great meeting. There was about 12 to 14 of us full-time traders there.
Mm-hmm.
So it was incredible. So I'm constantly kind of looking for that again, where there's a community of people who are very dedicated, who have differing points of view that all of us can learn from each other.
Oh, great. Great to have you here. Welcome. Yeah, so we've been doing this for almost since 2020, almost more than 4 years. Hopefully, I'll continue to do this, as long as I can. All right. So I see some comments. Proud owner of Broadcom, you got to put assigned. Looks like she says assigned too. Why not buy a discount and collect dividend too? Yeah, that's the power of options. And again, in this Saturday meeting, I generally don't get into the details of options unless someone has a trade to discuss, etc. But currently, I'm running an options boot camp. We took a break for 2 weeks because of travel. So we're gonna resume it from Wednesday. So that session is on Wednesdays. I'll schedule it on a meetup. And I think we have done 8 sessions. So out of a total, I have 14 sessions that I cover in the boot camp. So we're gonna do the 9th session on coming Wednesday. Okay. So if you're interested in specific discussions around options, Greeks, theta, gamma, vega, deltas, managing risk, different option strategies, you want to maybe hedge your portfolio selling call spreads or doing callers, etc. Yeah, we'll get into the details of that. If you have a questions, bring it in this meeting. Unless there is something new that is coming up, something new that I've learned specific to options, I don't talk about it unless there are questions. Okay. So that's I generally want to focus on long-term investing, what's happening in the market, any stocks, something new that I figured out this week. All right, with that, let's get into today's meeting. Thank you everyone for joining in, and hopefully you'll find this useful. And I'm gonna see you again next week. So let's first look at the state of the market. Is NVIDIA on top? Signals that we have reached the top. This week, NVIDIA, for a brief moment of time, was the biggest company from market cap perspective in the world. So if you look at infinitemarketcap.com, you will see, of course, gold is now 15 trillion. NVIDIA had briefly topped up Microsoft. I think on Friday and Thursday, NVIDIA gave up some of the gains. So I think it has now retraced back. But there was a period when NVIDIA was the largest company by market cap. More importantly, if you compare the numbers, Microsoft has as much amount of a free cash flow as a total revenue of NVIDIA in 2023. In 2024, I think NVIDIA is expected to do what, $120 billion in revenue. Microsoft has what, maybe close to $80 billion of free cash flow last year. So I don't know how it makes sense to me, but markets are markets, right? Right now, everything has been driven by AI. And as we talked earlier, I don't know if this is 1995 or is it 1999. I think that's a very difficult decision to make. Is it 1995? Can this continue for another 4 years before this burst out? Or are we already in 1999? And one bad quarter from NVIDIA, not even bad, one normal quarter for NVIDIA where they haven't beaten expectations, will we see people running for the door or taking profits on NVIDIA? I won't blame those people. NVIDIA is up by how much? Maybe more than 100% this year, 170 or something like that. Let's look at where is NVIDIA. NVIDIA is up 162% for the year, right? What a growth it has seen from $800. I mean, the year started here, right? $50 or $480 from $50 to now $120 at the start of the year. So yeah, and not just NVIDIA, I think it's also driving anything else that has got AI attached to it. And I came across, and there are a lot of, I would say, fund managers or fund houses that are taking advantage of this craziness in AI. Last week, I came across a new fund, which is basically opening up basically a private credit fund to invest in AI startups. So there are two bubbles that I see going in the market right now. One is around private credits. Right? And the reason is because fewer companies are coming to public market, it is becoming more and more expensive to, first of all, go public and then to stay public. Right? There are so many, I would say, regulations around disclosures, etc., that it's too onerous for any company to stay in public market. That's why, I mean, we are seeing the number of public companies in the market has been decreasing. Right? We are what, maybe close to 3,700, 3,800 companies. 40 years ago, we used to have almost 10,000 companies available in public market. But now companies have to, let's say, keep a few $1 million just for shareholder lawsuits. We see left, right, and center, any share falling by 25%, you will see bunch of lawyers, so-called, I don't call ambulance chasers kind of lawyers, sending out an email saying, hey, if you've been hurt by this, we are ready to file a class action lawsuit. This is the cost of doing business. So what's happening? Many companies tend to stay, private. And then there are many fund houses who are, creating ways to give exposure to investors, to those public companies. And it's a risky path because we don't know what those company financials are. We don't have access to their S1s. We don't have access to their financials. We don't have access to any information, right? And so, yeah. So we see many fund houses coming up with, these private credits also, because nowadays, even, these mortgages, etc., are super expensive. Loans are super expensive. And if you don't qualify for that, you might want to go for a private credit. So I saw private credit plus investing in AI. I'm like, yeah, bubble on top of a bubble. You mix two bubbles, you're going to get a bigger bubble. So be careful out there. A lot of stuff related to AI is happening. I don't know how long it will continue, but as an investor, I guess, it's our own, we have to exercise our own judgment. Sam asks, can you explain FB software AI versus NVIDIA software, hardware, and software AI? So right now, NVIDIA is mostly, so NVIDIA is at an infrastructure layer. Right? So if you were to look at overall AI, how the AI will benefit you. First, you start with, at an infrastructure, which is your chips. You need chips because AI need a lot of computation, specifically like generative AI, when you're actually training it. So there are, I mean, a so-called AI has been around in different forms or a shape for last 10, 15 years, right? Someone earlier used to call it machine learning, in which the machines learn by themselves, right? Prior to that, we had automation, right? ERP. 25 years ago, ERP was a craze, right? Let's automate. Let's connect various systems, right? HR is in silo, finance is in silos. Let's connect all the systems into an enterprise resource planning. That was a craze. Then 10, 15 years ago, we started because the chips became faster and faster. We could compute. We could use faster chips to do a lot of data analysis. And the data started to explode after 2010, once we had, with the proliferation of smartphones and the social media apps, you started getting all sets of data, right? Not just the data of, a regular, let's say your banking data, etc. You have a structured, unstructured data, an image is a data, a like is a data, a comment is a data, right? A PDF is a data. So with the explosion of data and the increase of chips processing capacity, we started to use called machine learning, in which the chips, in which the software would use machine learning algorithms to find patterns, etc. What is different is the generative AI, wherein you don't have to feed, the predefined, let's say, logic or formula, right? It will learn by itself. And that happens via two steps. One is your training, and the other one is inferencing. Training needs tons and tons of data, right? How does a computer understand? For us, it is easy to understand that it's the picture of a cat. How does a computer know it's a picture of a cat? So the trainers will end up showing 1 million pictures of a cat, in different forms, different shapes, different skin colors, different, orientations, then the computer understands, oh yeah, this is actually a picture of a cat. So training needs tons of data and tons of computation power, and NVIDIA has been at the intersection or at the right time. They have the chips that they use for gaming, because gaming needs a lot of computing power, a lot of computation power. And then they realize the same chips can be used to do a parallel processing of data, right? Instead of a CPUs, which is serial processing, you do process one after another. GPUs do a lot of parallel processing, and we need parallel processing to process the data. So NVIDIA found itself at the right time when these things were taking off. So that's where NVIDIA at the base level, that's their USP, is their chips. Started with Grace Hopper, H100, then H200, 200 or 2000. Now we are talking about Blackwell, and then the next generation of Blackwell will be, I think it's called Robin or something like that. And then NVIDIA has built CUDA software systems on how to best extract the maximum value from those chips. So, but for even Google has have their own software. Google creates their own custom chipsets, but Google use NVIDIA chips. So there is no one who can beat NVIDIA today in terms of how powerful their chips are. Now, the bigger question is, we have seen this story before. When internet came along, the infrastructure players, broadband players providing networking, routing gets faster routing, faster network, because there is tons of data that will move around in internet. Yeah, that's where initially all the value will go. All the value will accrue to the infrastructure player. Next come at the second layer, once the infrastructure is your data, right? Without data, and when I say data, it has to be a data which is, cleaned up, not just a junk that you need to, the whole ETL project, your ETL process, that your data transformation, make sure it is in a consumable fashion. Right? So those who have tons of data and original data that can be used to train the models are become important, right? That's where the whole only investing thesis, if I would have on Reddit, is, gosh, they got tons of data. Otherwise, Reddit as a company, we reviewed it as one, right? And I think if you go back and look at that recording, I said the only reason why I would invest in Reddit is because they have original data that they can charge other customers for and allow them to use their data for training these models. And then later on, we learned that Reddit has signed an agreement with Google so that Google can use Reddit's data to train their Gemini model. So that's the second layer. Third is, which is where the eventual value proposition of AI is, the applications. Today, I don't see that I still have those, groundbreaking application for ChatGPT is one. That was the one application which was groundbreaking and opened our eyes to what a generative AI can do. Beyond that, we haven't seen anything which is like a money-making or money, application yet. Yeah, we got a Microsoft Copilot. You can pay $20 and use it. Whenever I try to use Gemini or ChatGPT, I still see hallucination, right? And I can live without these AI applications so far. But eventually, these things will be fixed. Companies, software companies, may it be Google, may it be ServiceNow, could it be Salesforce? We don't know. Companies will start to incorporate AI to do more at a lesser cost and do it more efficiently. But that's not where the value will come from, because the moment every company have AI for their internal processes, you don't have any advantage against your competitor, right? As long as you are the only one who's using AI for improving your process, you can churn out your product faster, you can churn out your product cheaper, and you can corner the market. Great. Moment your competitors have it, it's a level playing field. Websites, your company having a website used to be a differentiator, right? In mid 99, maybe 1996, 1997, that time frame. Not anymore. Everyone has a website. So Professor Aswa Damodaran says, he has a famous saying, if everyone have it, and it relates to your advantage, right? Tech advantage or any kind of a mode that you're trying to build in your business. If everyone has it, then no one has it. So if, let's say, Salesforce.com, HubSpot.com, or all the companies in the CRM space start to include AI, generative AI in their business, there's a level playing field. So I think maybe in the start, we might see some companies being valued higher because they are using AI in their internal processes. Maybe let's say Walmart is using AI to more efficiently manage their inventory on their shelf, right? Soon everyone else start to use it, that advantage is lost. On the other hand, there will be applications that will come out at a consumer level. I'm still waiting for that kind of an iPhone kind of application, right? To see who captures that market. There's going to be a new Netflix kind of an application that might come out. I think that's where the final majority of the value will go. So value will start at the infrastructure level, goes to the data, and eventually will end up in an application level. We've seen that in internet. We saw that in mobile economy, and we're going to see the same stuff on AI sides. Infrastructure at beyond some point of a time becomes a utility. No one wants to pay high for utility. As long as utility is novel, great. You can capture that market. Beyond that, after some years, you come to expect it as it is, right? Today, Comcast doesn't have, like providing internet services. It's not a huge, you don't enjoy huge multiple because just you're providing internet services. Has internet changed the world? Yes. Do we need internet? Absolutely, yes. Who is taking value out of internet? It's the Amazon, the Googles of the world, and not the Comcast and the Cisco of the world. Cisco did. Juniper's did. Broadband companies did at the start of internet era. So right now we are at that start. We are seeing a lot of value being accrued to the infrastructure companies. I don't know how long we'll continue, but at the end, I think it will go back to the applications. Now coming to the FB, Facebook is using AI for improving its internal processes way better than any other company could do, right? I think Mark Zuckerberg had mentioned in the previous earnings call that 50% of the content shown on Instagram is generated and suggested by AI, right? And by generative, it's not that the developers are writing code or logic to figure out which content need to be shown. Of course, they have for the rest 50%, but nowadays, the models are learning by itself, and they're suggesting the content to the viewers. So imagine 50% of the content is suggested by AI. That's like zero marginal cost, right? You don't need more software developers or probably you need half of the software developers for the remaining half of the content, right? That increases your margin, reduces your cost. Could there be another social media company could do the same? Of course, but Meta has other big advantage, which has nothing to do with AI, which is around their scale, right? So it will be difficult for any other new social media company to come in and disrupt Meta. So I hope I answered your question. Chandra says, welcome back, Vivek. Thank you. General question, clarify. When a company announces buyback in general, when do they start buying back the stocks? Do they not start at the end of their buys? They do not. So they do file it in SEC filing when they buy it. So generally what happens is that when they get an authorization from the board saying we have we've been authorized by the board for let's say $1 billion of share buyback. And ideally, I would prefer that the companies buy the shares when the shares are down, right? Or when the shares are trading at a lower than the company's intrinsic worth. right? But most of the managers or the CEOs don't do a good job on buying back. They're all drinking the same, Kool-Aid, and when the stocks goes high, they buy back the shares. I don't know why, but yeah, they don't announce the start. They don't announce the start and the end dates. And I have seen cases wherein they'll say, "Hey, last year we got authorization to do a $10 billion. I still have $1 billion left. And so for next year, we only gonna get an authorization for $9 billion." Right? So we don't exactly know when they're gonna buy it. But I would prefer if they buy when the stocks are down and not when the stocks are up. PG&E rise 3x, Comcast reduced $25 after 2.5 is at 40. Okay, good for you, good for you. Maybe I should call Comcast. I'm paying way more. NVIDIA pullback expected at this price point. I mean, I've been expecting NVIDIA pullback much earlier, right? But the craze in, I mean, markets can stay, and I don't want to go on the record saying that it is irrational. My point of view that it was irrational, but markets can stay in a state of entropy for much longer than you might expect. So, I mean, imagine NVIDIA announced its split, was it the 10th June or something? 2 weeks. So this is a 10:1 split, right? This was like maybe 7th, 2 weeks ago, right? And it's up like, it was what? When they announced, it was $100. And I think when the split happened, it was 110, and then it was like 140, but 40% up in 3 weeks just on buyback announcement. Generally, you will see that the stocks run up after the announcement, and once the split is done, it's like buy the news, buy the rumor, sell the news, stock will recover and go back, retrace. We didn't see that with NVIDIA, it just continues to go up. Right? Again, we are approaching end of June, and as if you're a fund manager and you haven't had NVIDIA in your portfolio, you will be severely lagging S&P. And probably it's a chance for fund managers to say, you know what, I'm gonna get behind this. I need to have NVIDIA in my portfolio. I don't want to miss it anymore. So it's a quarterly result that is coming out. And like it or not, fund managers, Wall Street, they focus on a quarterly result, and nothing can be worse than, your peers, some other folks making money, and you are, trailing them. So I guess some of that's also happening. Everyone is now on one side of the trade, is like go long with NVIDIA. 1960s or whatever, 1970s, Nifty 50, one-sided trade. You can't be, at that point of a time, fund manager, you can't get fired for buying IBM. That used to be the case. Today, you can't get fired for buying NVIDIA. Right? I think that's where, whether it works out or not, at least you've done your part. You got NVIDIA in your portfolio.
Vivek.
Yeah.
The quote is, you won't get fired for buying IBM computers or typewriters, but how can we buy NVIDIA chips? I mean, it's not very consumer.
No. So I think I was talking about a stock, even for the fund managers, when those Nifty 50s were there, that point of time, your boss, you may underperform it, you may not make money for your clients, but you won't get fired if you held IBM. So today, I think that's the case with NVIDIA. So Chandra mentioned that NVIDIA stock has multiple reasons. Buyback, yes. CUDA service income, I think that we already talked about it. Chips plus CUDA. Funds allocating more. XLK is one stuff that I'm going to talk about, the whole rebalancing. So we'll delve deeper into that. Retail easy with price point. Yeah, because after at the end, so number 4 point is something which is my pet peeve, right? Because splitting doesn't do anything to the value of the company, and it has got zero impact except if you are trading in options, right? But we have seen time and again, retail get excited about it, right? Buying $1,000 of NVIDIA or buying 10 shares of NVIDIA at $100, is exactly the same thing. It's all what's the percent of the company that you own. But anyway, chip demand exaggeration. Yeah, right now everyone wants chips. Other thing could be maybe there's a gamma squeeze. I don't know. I didn't look at long call options on NVIDIA, but let's see where they are. What's happening on, I can imagine like 103,000 at 176, 32,000 at 194 price point. Open interest 32,000 calls. Someone thinks that maybe NVIDIA will go to what? 194? Or someone is just trying to take, it's 2,000 at 255 expiring in 27 days, 13,000 at 228. What's that? 200. No, I think this is the biggest one. Okay. Is it causing a little gamma squeeze and that's causing shares to go up? Yeah, I would agree. There's a little bit of that also. Right. So if you're buying a long out of money call options, trying to buy it as a lottery tickets, the market makers who are selling you these calls have to hedge it by buying the stocks. So end up market maker will end up buying stock, which will push up the stock price a bit higher. Or let me put it this way, that's put up another buying pressure on the stock. And then looking the stock going a little higher, if the retail investor, oh gosh, I need to buy more calls. That's what the whole gamma squeeze is. We've seen the worst, or maybe call it the best case of gamma squeeze in GME in 2021, right? And GME is back. But this time they didn't have a gamma squeeze because no one had diamond hands. Even the roaring kitty had a paper hands. So yeah, I'm not interested in buying these calls on NVIDIA, guys. Well, that's okay. I think I went through all the questions. Anyone got NVIDIA options? I think I have probably a puts that I've sold on NVIDIA. I think I have a strangle on NVIDIA. So I have a call that I've sold at NVIDIA and I have a put that I've sold at NVIDIA. Those are the two ones that I have on NVIDIA. All right, let's see what else. With the rally in the market is, probably it's not a news, but all the market rally is driven by few concentrated tech stocks. So there was an interesting chart. I think it came in the Compound and Friends, where they look at, I think, on, where, what was it? Was how much percentage of the stocks are hitting their all-time highs. So it's if you look at the communication services, and I think this, no, this is consumer discretionary. That's where we see like more than 60%, 70% of the stocks hitting their all-time highs. Others, not that much. Financials are like less than 20%. Energy is like energy is less than 20%. The other one is the tech side, right? 60%. If utilities got caught up because of AI, you don't see this often when the utilities are doing, is putting up such a great performance. Again, the narrative is AI. To run these super, expensive chips, they consume a lot of power, and you need to generate power. So all the power utilities have been doing pretty good this year. Other than that, not much. Like S&P is like 40% company, 60% of S&Ps is not there. So it's a very narrowly concentrated rally. I don't think it's a huge red signal though, because even in the past, we have seen a fewer stocks or concentrated stocks driving this, the overall market higher. It is just because the market itself, the S&P is market cap weighted. So it's like I would say, virtuous cycle. When the bigger company becomes bigger, it starts to impact the impact of that company on the S&P 500 starts to become bigger itself, right? But if it starts to go down, then we will also have that vicious cycle wherein if the NVIDIA falls down, it will have a much bigger impact on S&P than other company falling down. But it's a concentrated rally. Sajid says, I'm playing both long and short NVIDIA through different time frames. Short-term short, long-term bull. Yeah, we can talk about it, Sajid. If you want to share what, then go ahead and unmute yourself and you can talk about that. She says both side puts and call options sold. Yeah, that's what I have. That's what the strangle is that I was talking about. I have, I think, 115 put and 155 call expiring for July. So if it gets called away at 155, okay, fine. Or maybe I'll defend. It'll depend on what happens in the next 2 weeks. Sajjan, are we also looking to rotation into banks or oil? I mean, I thought if you say we means maybe question to me is I always have some exposure to energy. I'm not that I want to increase it, but currently I have a short put on XLE. Right? Is the market looking to rotation? We don't know. I mean, the banking was doing better, I guess, a month ago. Let's look at a banking XLF and see where XLF gone. Oh, come on. Let's see. XLF. This is your bigger banks. It's the ETF for bigger banks. Yeah, I said it's done pretty well for this year. XL Energy has been beaten up because of overcapacity. I think, was it May or somewhere in June, where in the OPEC countries came and told that they're not going to reduce the production of oil as much as what they were planning earlier. So that's where the energy got hit. But I guess, I do want to have exposure to energy and financials. Of course, the biggest exposure currently I have is a tech. But yeah, I always would want to have exposure to others. Energy was the best performing for me in 2022. Everything else was back. 2021 and 2022, energy was up like 60%. So it helps if you have a diversified portfolio. Do you look at fundamentals technique both before buying an option? So first thing, I generally don't buy option. And I generally sell option. So yes, I look at a fund. So options is, for me, options is a way to build my portfolio for long term. So if I let's say looking at NVIDIA, right, 100 and whatever, it was like 140, and I was thinking maybe it comes down to 115, I might be okay to buy, or if it becomes 155, I might be okay to sell some, right, because it's been going like 90 degrees. So that's where I sold options at 115 and 155. So if it goes to down at 115, I want to buy it, I'll have an opportunity to buy it. Yeah, I sell calls. I sell calls, puts, both calls, puts, and all the combinations of it. Iron condors, iron flies, ratio spreads, back ratio spreads. Expiration right now, I think it's a July. But after this week, no more July. We'll start building portfolio for August. I'm getting too closer to July for new positions. Probably I'll just manage anything which is for July, but no more July after a week. Kawar Nehal asks, have you done any comparison on the annual ROI on long-term method and ROI for a common mutual funds? So I think from a not on a common mutual funds, but let's say look at SPY, because most of the mutual funds, they don't post fees. They don't beat the S&P 500. Right. Number two, mutual funds are tax inefficient. We're gonna talk about it. So I would rather have all the ETFs and not the mutual funds. Number one, mutual funds fees are high. Number two, they are tax inefficient. So I don't focus on mutual funds, but yeah, I do have a lot of exposure on ETF. My biggest position is ETF, right? S&P 500. And I'm happy with my return on investment. Thoughts on IBM stock and its play on AI. I haven't looked at IBM for quite some time though, but let's IBM. What I don't like is almost no growth. It's a completely mature company. You know, the revenue is growing at about 2%, 3%. Maybe let's look at a quarterly basis. I won't be interested in this for my portfolio. That doesn't mean that this company is not good, but let's look at 10% operating margin, 10% profit margin. I think we have a better companies out there than the profile of IBM. Yeah, it's a dividend payer. I don't know what's his dividend payout ratio. Does it show it here? Overview. Net income dividend 3.87%, right? So you can't. So if you are a dividend lover, you know, like to get this regular stream of income, you can have. I mean, it is paying today. Right now, the yield is almost 3.8%. Plus, if you think that it will have a tailwind from AI, I don't see it yet. I mean, IBM is way behind than the other cloud providers. Well, that's the only play that IBM had was to catch up and maybe build their own IBM cloud. I mean, they do have their IBM cloud, but who talks about them? AWS, Azure, Google Cloud, Oracle. Maybe then it is IBM, right? Maybe distant fifth. No one talks about IBM cloud. So is it getting some, initial? So is this a company that I would like to hold in for next 10, 15, 20 years? No. Looking at their growth profile, looking at the operating margins, and I don't see why I would want to hold it for next 15, 20 years unless, something has changed. But that's just me. I don't want to buy into a company for next 6 months. Is there some short-term tailwind because of AI, which is lifting IBM? Probably. But then that's not my style of investing. So I think probably there are better companies than IBM for me personally, which I would like to hold for next 20 years. Yeah. Towards the close. Okay, so we'll look at AVGO later. How are mutual funds less tax efficient than ETFs? I'll address this topic when I'll go through today's one topic around diversifying without paying taxes. And I'm going to talk about the whole ETF rebalancing and what did I see in the market, and that piqued my interest, and I dug deeper yesterday and realized, oh, this is different. Okay. All right. So S&P performance, guys, you can't complain, like 15% for the year. And I feel pity for the folks who kind of, cash out because 2022 was bad. And that's the reason why, you would want to hold a lot of a position, cash in your portfolio to go through those 2022s. Because since 2022, 2023, S&P was up, 26%? Now another 14%, right? That's what, maybe almost 50% higher from end of 2022, which is great. Can't complain about it. So Only sector which is still in red is real estate. And again, I think that's because of the commercial real estate. Yeah, QQQ did much more. QQQ was up 40% last year in 2023. And today, QQQ is good, up almost 20%, I guess. Yeah, 19.27%. What's your opinion on ASO? What is this stock? I've never looked at ASO. Academy Sports. 3.98 billion. I never looked at this company. So currently I hold no opinion about it, but the trajectory doesn't look that great. They've been losing revenue instead of growing it. And again, this is my first time I've even heard about this company. They've been buying back some shares, which is good. 11% operating margin. What's their ROIC? %14 return. Not too bad. Looking at their balance sheet, 347 million of cash and cash equivalents. Going back to income, cost of with this. You should find out what's happening over the last 2 years that is causing decrease in revenue, because that is a little concerning. Otherwise, from I think, because this is not a tech company, I'm assuming, or maybe, is this a tech company? What is the ASO? It's a sporting goods company. Okay, so yeah, for a sporting goods company, I think from that, so basically it's a retailing company, I guess. I think the margin profile is okay. I wouldn't like this margin profile for a software company, but for a retail company, I think this is good. But something is not going good over the last 2 years. So unless you find out that is something has materially changed, or is this a short-term tailwind, that's something that you need to be careful about. The company is buying back shares, which is good because they're reducing their share count, which is a good shareholder-friendly measure. They have a decent operating income, right? But I will be concerned on what's happening here over the last 2 years. If I look at quarterly, yeah, either the competitor is eating their lunch or something has happened that they've been, instead of increasing, they've been decreasing the revenue. So I think that you need to understand in the business what's happening. This is what my 2 minutes overview would be. If I were to buy a stock, I'll get into a lot more details into it. If I were to do a full analysis, like we did on Hims on Hers, right? I don't know what this company, so you must figure out what's happening in the last 2 years. What's your take on Intel? Intel is only reason why I'm still holding Intel. It's a strategic, because that's the only company that is making chips in US. It's a US company making chips in US. Of course, now we have a TSMC building plants here, but TSMC is still Taiwanese company. But Intel kind of lost its way. And if you really want to stay invested in Intel, you have to have a lot of patience. I mean, Tad Gelsinger has said himself, right? Minimum 5-6 years before those fabs start to make any meaningful impact on the business. Intel is in now investment mode. They want to become, of course they have their own fabs, but now they would also want to become what TSMC has become, which is like fabricating chips for other companies, right? Intel used to do only for themselves, for their in-home consumption, but now they're starting up a new business line of creating chips for others. Creating chips is not easy. Putting up a new fab plant is not easy. Sachin can tell you, he works in a semiconductor company. It will take years. So you got to be really, really patient on Intel. I'm not too big bullish on Intel, so I have a very small exposure. Only reason is I don't think the US government will let it fail. So who else makes chips in US? Which other US company makes chips? Global Foundries, very small. Like AMD, no longer. NVIDIA, never have. Apple, never. Intel is the only one which has got a fab. So it is strategically important. Just like Boeing may be strategically important, even though the company's business is like broken, they're having quality issues, there are tons of issues, but it is strategically important for US. So that's my take on Intel. I'm still holding. I have a very small position, but I'm not looking to add anything to Intel. Do you look at the charts or just fundamentals? I rarely look at charts. Charts I look at when I have to start initiating positions, but for me to decide whether I really want to own this company in my portfolio, I don't look at charts. I look at whether I love the business or not, whether company has a moat around the business, go through the competitiveness of a business, and do I want to become an owner of that company? Eventually, when you buy a share, you are a part owner. So last talk, Toast, can you review this? Toast has been making a lot of news. My only worry on Toast is, what's a moat? I mean, they've been growing like crazy. I know. It's been in FinTwit. My only concern around there is there are other players similar to Toast, like we got a Square, right? And Square could decide to move into the vertical of restaurants. So at the end of the day, payment processing is a low margin business. It's a high volume, low margin business. And other Toast is expanding into providing a full software to restaurant. That's where their focus is. But I am hesitant on the competitiveness. What's a moat in this business? And today, I don't want it. They're growing like crazy. That's where they look at the revenue growth, 30%, 40%, 50%, right? So if you look at from the standard rule of 40, probably, yeah, it surpasses the rule of 40. Right? Let me go to the annual side. Revenue growth 60%, 40% annually. But they've not been able to run the business, run the operations profitably. So my question is this: in my portfolio, and again, you could be you, I'm not looking to add a company at a very early stage, which, if it works out well, could be a multi-bagger. But there's a risk. I don't want to invest in a kid which, if it goes to Harvard, is going to reap in tons of benefit. But right now, that kid is in elementary school. I want to invest in a kid which is in the middle to high school, because that's just where I am in my investment or portfolio stage. That doesn't mean I don't mean to say that the kid is in elementary, doesn't put, is never going to graduate to Harvard. I don't know at this point of time. Toast is in elementary school. So if you start investing at elementary school, and if it really goes to Harvard, you're going to reap tons of benefits because you got into early. But maybe he has a different mind. Who knows? Middle school say, you know what, I don't want to go to college. Right? So depending on where you are now, coming to the financials, looking at its operating income, it was all negative. That means what? That tells me that they cannot run their business operations profitably. That means they will always have to depend on either debt or money that they've raised from selling the shares. Right? And then you have to look in, because through the business, they can't generate any any income. I'm not even talking about the net income, post-tax. I'm just talking about operating income. So at some point of a time, they might need a ventilator. And so I'm not interested. Today, right now, I'm not looking at if it had a huge moat, if it had a monopoly kind of a stuff like ASML has, but no one else does what ASML does. And if ASML was a negative operating income, maybe I'll be interested. Toast. I mean, they have a, and again, I've not looked into this company, so I don't know how much of a percentage of restaurant software do they own. But at the end of the day, it's a payment processing and restaurant order management system, right? There is no mode, kind of big mode in this. Any other business coming in and telling to the restaurant, I'll give you at a 50% cheaper, take 1 year off. As a restaurant owner, I might just switch. So I'm not interested in those. So that's my quick take. Intel got funding. Yes, they got funding from that whole CHIPS Act. So did I think others. TSMC also got funding. How much of percent of capital would you invest in one stock from one sector? When it comes to capital allocation, I don't in an individual stock. Right? I generally try to cap my own investment, like my own cost investment of 3% to 5%. Right? And if it continues to grow, great. If it grows more than 15%, I think that will start to give me a little bit of eligibilities. I don't have any individual stock which is at that stage yet. I think my maximum position in individual stock is maybe 5%. ETF, I'm happy to own SPY at 12, 15, 20% of portfolio. But individual stock, I guess, at a 15%, I will start to feel a little jittery about it. But I have a long way to go. Lithium motors. How long do I hold it approximately? I would like to hold it forever. So there is okay, that reminds me. I think earlier someone, I had covered, long back, I had covered in some sessions around basics of investing, right? How do you start investing? How do you, then, pre-investing checklist, what you should do, what I would do on my financial side before I even think about investing, then during investing, how do you find good stocks, etc. And then how do you stay investing? And then there is eventually when I will sell. So I know some of you had asked for those links, and now I have that handy. So these are the 3 sessions, 91, 92. Oh, sorry, the last one is 93, where I covered the investing process, which also includes when I will sell. Right. Ravish asked if with the one earnings has a gap down, do you sell it? No. So in this, I have covered why are the reasons when I will sell it, right? Maybe the business has changed. Maybe the goal that I had, maybe I bought this stock with the goal of, I need to go on a vacation. And now it is a time for vacation. I need the stock to deliver and I need to use the proceeds, right? So I've talked about investing, when I will, what are the reasons for selling, I think in the last session. So go through it. I've covered long back the overall process of investing. So no trail stop loss. They are not. I never use stop loss in my life, even though I've been using options over years, with people think, oh, you're day traders. I've never used stop loss in my life. I guess basically value investing, I guess every investing in value investing. So I don't subscribe to value investing versus growth investing. I mean, I own companies like Amazon, Mercado Libre. Those are not value. Mercado Libre is not a value company. It's a growth company. But I know that currently, I mean, I think in the future it's going to increase its value. So I'm okay to hold it. Are we allowed to speak? Sure. Just say that, hey, you want to talk something and go ahead.
I have a question. So when you say you don't have a stop loss on your options, how does that work?
I said I never had any stop loss. I never used any stop loss in my life.
So how does that work then? You just let your trade get zero, or how does it work?
I mean, so when it says, so now on an options, because I sell option, I have a profit target where I will go out. So we talked about,
I think you are doing selling options. She
yeah,
might be doing
I
buying
don't do,
options.
I don't buy options. Buying options doesn't work long term.
I'm
So
actually trying to sell options. Recently, I started selling options, but still, there is a chance that the trade could go against you.
yeah,
So, if you don't keep a stop loss or a target, how do you get out
yeah.
of that trade?
Okay.
You're
So
not.
there is a target. I think in whatever session 7 or something, I talked about uh trade exit criteria. So I do follow that, my exit criteria of when I will get out of that trade. So I thought when the question came for stop loss, I thought that was more related to, if a stock goes down, do you just sell out because the stock has gone down? No,
Yeah,
Yeah.
I think that I understand because you are into value investing. So I understand that you only like you keep the companies and you don't have to sell it at stop like gap down or something. But in options, it's more faster. So that's why I just wanted to ask
Yeah.
uh
So
more
so
about the
I
stop.
okay, so I covered that in drill number 8, trade closing checklist. So wherein say, when do I close the trade? So which also talks about at what profit target I'll get out, or if it's going to a loss, then what's my, I call it a stop loss or whatever, when I will get out and close the trade. Because at that point of a time, looking at your probability of stock coming back into a profit zone may be very less, right? At that point of time, you take a loss and move on. So I talked about and covered that in drill number 8. So you can.
I just started selling options like a month ago, and I've only traded like 3 options. I just had a personal question. So, when you sell an option, have your option ever been exercised? Has it ever been exercised by somebody or no?
Yeah. So you will, because you're selling, you will be assigned. You don't have a right to exercise your option, but you will be assigned the option. So yeah, assignment does happen. Sometimes it happens surprisingly. And I think last week or week prior that I talked about, I got assigned like 4 weeks before expiration because of a dividend. And
Oh,
so we talked about it in I think this drill number 3, how to find out, in drill number 6. We covered the whole, how the exercise assignment works, and how do you find out if you are at a risk of early assignment.
okay.
So Friday, I closed my QQQ short calls, my hedge trades, even though they are expiring on July 12th, because those were way in the money. QQQ is going to declare dividend. I went and looked at NASDAQ, what's their history of dividend declaration. And then I realized, oh gosh, the extrinsic value left in QQQ is less than the dividend I will get assigned. So Friday, I spent a lot of time in cleaning it up and closing my deep in the money short call that I had on QQQ. Otherwise, I would have got assigned. So I just didn't want to get through that assignment process. But in number 6, I talked about how do you identify if you are at risk of early assignment or not.
Can you please share the link for this one so I can just open it? Yeah.
So
Thank you.
yeah, you'll have to register, but I mean it's available. You don't have to pay anything.
Yeah, I'll definitely do that. Thank
Okay.
you.
All right.
Vivek, can you cover about one stock named Baidu?
Baidu, I haven't, again, I mean, I haven't looked at Baidu for some time. I do hold a small portion in my portfolio. Baidu is called the Google of China, and I know they have got a good recently on the AI stuff, but you have to be really, when it comes to investing in companies in China, one thing which I've not been able to put value is the risk, the sovereign risk. So the company may be excellent. Look at Alibaba. Alibaba is the most undervalued company in my portfolio. If Alibaba was not in China, I would be buying it hand over fist. but I can't buy it because it is in China. There is no way I can put a number quantitatively figure out what the risk of it being in China is. So even though we talk about Baidu, it may be a great company. It's one of those big tech stocks, right? There are 3 or 4 big companies in China that I have exposure to: Baidu, Tencent, Alibaba, and then there are smaller, some EVs, etc. Right? But all these companies are beaten down because of the economic, the whole real estate issues in China, and then the China stock market. While US stock market was up 26%, Chinese market was down, I think, more than 20% last year. So all the stocks are in, I would say, available very cheap as compared to historically. But big risk, and which is why many of the institutional money started calling China uninvestable in 2023, was the risk of CCP, which I don't know how to put a number to it, how to quantitatively put a number to it. Only thing I can do is to just make sure exposure is limited, because the stock would go down to 0. What do you do?
Vivek,
So
my formerly employed friends in Shanghai and Hong Kong are not optimistic. So that's saying that most of them aren't employed now, but they're not optimistic. So that's a huge indicator.
yeah, China. See, the problem is you can't trust the numbers coming out. Like unemployment number came out, the numbers were large, and Chinese government said, you know what? From the next quarter, we're not going to show these numbers. Boom, problem solved. And no unemployment. What do you do? How do you put a risk factor to such stuff? Well, what if Chinese government tomorrow says and say, you know what, we're going to take over Baidu?
Vivek, can I explain some things? Well, in Shanghai, the Shanghai I left has totally become gentrified. They don't have these street retail any longer, these small shops. And so, when you have formal businesses, cost of doing business goes up. So who can afford it? Oh, and also there was a 2022 and 23 inflation.
Yeah.
So there are reasons behind it.
So while Baidu may be the great company, that's why I don't spend too much time on China, because there is one factor which would override all the great things that the business may be doing, which is what the government can do. They can come up with a random law like they did in 2022, wherein all the tutoring companies suddenly went belly up, and they banned the for-profit tutoring stuff. And all the stocks that were listed are like Oriental Education. There were a bunch of them, right? They all almost like went down to 0. What do you do? They lost 80%, 90% of value. How do you factor this risk? I have no idea. So you have to be really careful. Having said that, I do own a little bit of a Baidu, but my cost basis is kind of less than 0 because I sold so much option on it that I've recovered all my money. I hold Baba. I hold a bunch of Neo and a couple of others on which, again, Neo is less than 0. I'm reducing my cost basis on XPEV. It's not at 0 yet, but that's all. You have to limit the exposure. So any qualitative discussion on the companies, yeah, we could discuss it for academic purpose. But if you're looking for investing, understand that there is one factor that on which you cannot put a number to it, and that could be the biggest driving factor.
Then how do you find out what is the best price to buy any of the stock? Like, is there any intrinsic value of the stock or DCF value?
No, so I'm not, so none of these things will apply to, let's say, a Chinese company.
Not Chinese, in general, like.
Yeah, in general, I don't do DCF, because then you have to build in a lot of assumptions. I would look at a reverse DCF to figure out what is being priced in, right?
Like, given the example, let's say Snowflake, what will be the fair value that stock can be owned?
Okay, I've not run, no, so I don't think there is anything called fair value of stock. Could be on, because there is always a competitive companies. So that would be, hey, like I think I did for a PayPal. I didn't do DCF, but when I looked at a PayPal, I'm like, it is 5% growth assumed, 5% or 3% growth assumed in PayPal business. I think PayPal will grow much more than 3%. Like our GDP will grow to 2 to 3%, and PayPal, I believe, will grow more than our GDP. Snowflake, I mean, we reviewed Snowflake way back when it was way overvalued. It was like trading for 80 times the sale. I'm not going to touch it. I haven't looked at Snowflake recently. But right now, I have a big concern on Snowflake. Right, all these hacks, etc. Lending tree hack. They had a data on Snowflake. CDK. So if you go and want to go and buy a car, your dealer can't process it because most of the car dealers in US use a software from CDK, and the CDK had all the data on Snowflake. Problem. Snowflake, I mean, there is recently a huge issue going around the Snowflake hack. So I won't even, not gonna touch Snowflake for now. All right, let's move. So want to go through the Ethereum price. So let me first ask, is it okay? Because if you're not interested on the crypto side, then I can skip it. Is it okay? We go through the
crypto. Crypto is not that great always.
No, I mean, it depends on project to project. Stocks are also not great. And if you invest in penny stocks, all goes to zero. Okay, Anurag.
Mr. Vivek, I just have a question before you switch to crypto. I just wanted to ask, do you also buy stocks that are already on 52-week high, all-time highs? Do you enter in stocks which are already all-time highs?
Yes.
Okay.
If I find that the business is still doing great.
Okay.
Right. So again, generally what I would do is to sell a put to give myself a little room for error. And if it comes a little down, I'll buy it. But I'm not gonna not buy the stock because it is at 52-week high. The reason it is at 52-week high could be because it's a great company. Right. So yeah, I mean, the current price has got no material impact or big impact on me to buy or not. If I like the business and I say, you know what, I want to sell a put on it, I will sell a put on it. Okay. All right. Okay, so let's look at Ethereum. So I was like, I think I also tweeted, I'm like, what is happening? Somebody from Ethereum community, please explain me what Ethereum is. Is it having multiple, that split personality disorder? Because I've heard various definitions. It's a world computer. That's how it started. Hey, we're going to provide a computing power for world. It's a Turing complete ecosystem. So if you give an instruction, it will get completed, right? It's a distributed computer. No, you can't shut it down, and no one person can just, or a government can shut it down. It's like an internet. So next other definition is a programmable money, right? Hey, it is like Bitcoin, but it is programmable. You can't do much. I should say you can't do much programming on Bitcoin with ease. Of course, there are Stacks project which allows you to run smart contracts. But yeah, it's a programmable money. Third is it's a digital oil, which was very easy to explain to traditional investors, because gold, oil. Gold is store of value. Hey, that's Bitcoin. It's a store of value. It does nothing. Instead of a rock, now you're having a digits in a Bitcoin blockchain that you own. And here Ethereum, it's oil. It is used to run the economy. Ethereum is used to run the crypto economy. You can build stuff using Ethereum. You can build an exchange using Ethereum. You can build a lending tree using Ethereum. You can build any other application that, like we have a Fatcaster, which is a social media on Ethereum, right? Twitter is building a Twitter-like application on Ethereum. So hey, it is a digital oil, which is basically runs the economy, That's another definition. Third one came as an ultrasound money. And again, I think they're trying to kind of compete for attention of traditional investors because now Ethereum is kind of a little deflationary after they introduced, I forgot the EIP number, but now, some of the portions of Ethereum is being burnt. A part of a gas fee is being burnt. So while dollars or any other fiat currency is inflationary, this is burning mechanism is like stock buybacks, right? Or is it a yield-bearing commodity? Because you could stake Ethereum for those who are validating transactions and you can earn a yield on it. So is it a yield-bearing commodity? The final one, which is the latest one, which I heard was, it is a decentralized app store. So this came from, I think, maybe it was a VanEck guys or some other guys. Probably, I think it was a VanEck guys. So it becomes easy for them to explain to traditional folks, like on Apple App Store, you have multiple applications. On Ethereum, you have a multiple smart contract, applications that use smart contracts. And Ethereum charges fee for every time you execute a transaction, just like Apple charges fee. Right? But Apple charges 30% take rate. Ethereum charges way lesser take rate. And that's the value proposition. You can make things faster, cheaper, uncensorable. And it's a matter of time when we will see a lot of commerce start to happen on Ethereum. I don't know if you tracked it, but a few weeks ago, maybe a month ago, we talked about the first it was not treasury, but it was I think it's the first, one of the bonds from BlackRock was actually launched on Ethereum. It's called BUIDL, BUIDL. And now I think they released their first dividend. The dividend yield is way higher than the dividend yield that BlackRock earlier used to provide. Why? Because the cost of doing the business, cost of releasing or creating this bond on Ethereum blockchain is way less than the cost of creating a similar product in traditional financial sense, right? And so I think they recently provided the first dividend, and then the dividend got automatically credited immediately because you don't have to go through the traditional rails and all that. So BlackRock is already using it. Yeah, of course, if we don't use it in day-to-day basis, but I guess it will be a matter of time. So it's not dead. Now SEC has approved it. The Ethereum to be listed, ETF to be listed on stock exchanges. On Friday, I think many of the issuers, they updated their S1 filing for Ethereum ETF. So I expect maybe in a month or so, we should have an ETF based on spot Ethereum. Right? We already have on futures, but spot Ethereum, we should have an ETF coming out maybe in a month or so. Just like we had a ETF based on a spot Bitcoin launched in June. And now we're going to have a ETF based on a spot Ethereum coming up soon because SEC approved it. So let's go through the VanEck price targets. Again, don't put too much faith on the numbers, but let's look at the methodology. What I liked was the methodology that they have used. It's much better than some of the others that I've seen. So let's go through this document. Okay. So first of all, okay, so I want to go through the takeaways. We'll come back to takeaways later. Okay, so why Ethereum? Why is the investment case on Ethereum, right? Why do we even, and this is, again, this is a stuff which VanEck or other issuers, they basically take to their traditional traditional institutional investors, right? Those who have been investing in, let's say, stuff like pension funds, endowment funds, institutional investors, hedge funds already know about these things, but those are the investors that need to be educated, right? So Bitcoin education has already started. Now the ETF is there, probably take a year before they become comfortable and start adding in. Now, if you have to talk about Ethereum, this is the investment case for Ethereum. It has got 20 million monthly active users, settling in $4 trillion in transactions while facilitating $5.5 trillion in stable coin transfers. If you have to transfer money internationally, right? How do you do it? It's expensive or it takes a lot of time. There are two ways, right? If you go to, and big use cases, your remittances, which majority of the folks will use Western Union and they'll charge you like 16%. Well, someone should just ban these people, man, 16%. Come on. But there were no other alternatives, right? Now, if we were to transfer money from, let's say, here to Vietnam, to your family in Vietnam, or Philippines, right, or Ecuador, you can transfer a USDT or USDC, and the other person over there has a USDC, and then they can get it converted to dollars, and it costs you zilch, right? So $5.5 trillion of a stable coin transfers happening on Ethereum already. Over the last 12 months, secures 91.2 billion in stable coin. I think the biggest is USDT, which is almost, I guess it was $70 billion US. The Tether coin Gecko, where is Tether? USDT, $112 billion in USDT itself. And USDT is on Ethereum. And then they talk about, $6.7 billion tokenized off-chain assets. I'll ignore this as well. Digital assets, which is mostly NFTs and all that. It went through its own hype cycle. The real use cases NFT will take time to come in. Centerpiece of this financial system is ETH token, which is, what they've updated their case. So looks like they probably provide this report every year. In the last year, it was a different value. Now this year, their base cases could be 22K by 2030. Again, this is not a financial advice. Don't go and buy Ethereum because, hey, VanEck is saying that it's going to be 22K. Right? I have seen crazy estimates in 2020, 2021 about Bitcoin and Ethereum. None of them has panned out. So, but it's good to know the methodology. That's what I want to focus on, is the methodology. How they came up to this 22K as a base case with the forecast of $66 billion in free cash flows. Right? Now we are going to the basic of value investing or fundamental investing. The value of the company is the total amount of free cash flows that the company will generate in its lifetime, discounted to today's date, right? So it's going to generate $66 billion in free cash flow, and they're using 33 times the free cash flow as a multiple, which is a high growth stock multiple for a tech stock. So similar multiple, you take this multiple, that's how they come to the valuation, right? Estimating market size is that total addressable market will be 15 trillion based on these industry verticals in which Ethereum will have a play. Finance, banking, payments, 10.9 trillion, marketing, advertising, social gaming, 1.1, infrastructure, 1.8, AI, 1.4. Guys, you can't have any discussion in today's world without talking about AI. And say, out of these are the total addressable big markets, right? Not everything is going to move to blockchain. The assumption is that only 7.5%, 20%, 10%, 5% will utilize blockchains. And Ethereum will have a 70% of the market share of respective one, which is generally same as, if you look at any protocol that came and had a traction, much bigger traction initially. Of course, there are more than one players, but then they generally tend to have in a corner 60 to 70% of the market. So far, nothing, out of the blue. Then they look at that 12 2 months, trailing 12 months TTM. The smart contract market share is this, total revenue is this. So revenue is nothing but the fees that you basically pay when you have to run a smart contract, right? And then the validators get their own cut because now they are validating those transactions. So the remaining one is a value to the token holders, to the ETH token holders, which is 3 billion. Current FCF multiple is 137. So 33, pretty reasonable FCF multiplication, right? Ethereum fully diluted value, right? 453. Total supply is this. Price is currently is based on the current situation. The fair pricing based on this is $3,700. Right now, I think trading at 3,400 or so, something like that. Now, this is the bullish bull and bear case scenarios. 70%, base case is 70%. Is the the overall we looked at these markets. Of these markets, 7.5% of 11 trillion will go on blockchain, 20% of 1 trillion will go on blockchain, 10% of 1.8 trillion will go on blockchain, 5% of 1.4 trillion will use blockchains, and 70% of that blockchain will be on Ethereum in base case. Bull case, 90%. Bear case, maybe Solana became much better. Maybe other XYZ was much better and people dumped Ethereum. Only 15% will use Ethereum. So then you run up your estimated revenue, global tax rate on crypto, revenue 15%, validators will get their take rates, blah, blah, blah. They came up with these numbers, right? This blew my mind. What the heck? What are you guys smoking? Right? So it could be anywhere between 360 to 154,000, right? So neither here nor there. You can use your own judgment around it. So why? The Ethereum daily active users have grown at 71% CAGR. The usage has been growing. Okay, what else to do? They talked about the Ethereum burn that was introduced recently, which is analogous to stock buybacks. Over the last 6 months, 1.58 billion or 0.4% of supply has been removed. Right? Then they start looking at the ARPU, right? Ethereum revenue per user, and compare with all others. Yeah, right now, because not many people are actually on Ethereum, they have got 20 million users. And so from that perspective, ARPU number is skewed to be very high. What else? Yeah. So we categorize Ethereum as a platform business similar to Apple App Store or Google Play. I don't think any other issuer or I've seen any other big player actually coming with the App Store definition. I think that it's the VanEck is trying to differentiate it for their own clients. So Ethereum currently so Google and Apple take around 30%. That's a take rate. Anything you do on App Store, anything you earn on App Store, Apple will take 30%. Ethereum currently takes 24% and 14% for non-DeFi. We believe that take rate will drop 5 to 10% over next 18 months as activity will shift to Ethereum layer 2 blockchains, which is true because the scaling work has been happening anyway. We should see more and more use the L2 for doing the transaction and then finally posting the end result on L1. So Ethereum could become like your account at Fed. So interbank transfers, you can do it. Like banks will do, you send your ACH file, they say, oh, move the money interbank. And then finally, we're going to update the reserve account at Fed. Okay, so this is how much each bank has. So similarly, the transactional level information could be on layer 2s, and the Ethereum would, this is where they go and settle. So then the take rate will drop. For more information on layer 2, so there was another report. I didn't have time to go through that report. From the payments angle, credit card processor, other payments app like PayPal siphon 1.94%, which is true. Amex charges about almost 3%. By contrast, on Ethereum, users pay 0.001% for a simple transfer. So we talked about it, like, remittances, etc., become much, much cheaper. Okay. Then they talked about some social networking platform, Farcaster. They currently collect 75.5 per monthly active user, which is great. Average daily time for app on Facebook, 31 minutes versus 350 for Farcaster, I guess, because those are the folks who are initial adopters, right? They'll probably spend most of their time over there. So I won't pay too much attention on this one. Then they talk about, we believe that the blockchains like Ethereum will become an important backend infrastructure for AI applications, right? Now, this something which could blow our mind is if eventually, we see the proliferation of generative AI, wherein the machine could start to think for themselves and start ordering stuff and start talking to other machines where you have another AI agents and all that stuff. In that time, we will need a system which is on 24/7, cannot be stopped by rogue players, and you can transfer the value at much cheaper cost. Right? So could Ethereum be the blockchain that this could be used? I think that's what they're assuming, and they're looking for 1.2 billion revenue that flows back to ETH holders, and that's all by 2030, right? Then they're looking at basically 4 buckets on which Ethereum makes money: transaction fee, layer 2 settlement, which is where things happen on layer 2. Then you put a settlement on layer 1. MEV, this is, I don't know how this is still legal. In traditional financial, this is illegal. This is trying to, what do you call it? In traditional finance, it's like a Flash Boys book, right? Before the order is executed, you basically put yourself in front of that order, you buy it, and then sell it to a higher level. So this is, MEV is called minor extractable value or maximum extractable value. But this does earn, revenue for validators. And then finally, security as a service is the usage of ETH as a collateral to back permissionless applications. Right? So these are the 4 revenue streams that they talked about. What else? We believe. Okay, so I'll skip all these. Then they talked about how much of a revenue could be from each of those big 4 sectors, with how much of the the market shares. 7.5%, 15%, and bear is 1%. And yeah, so I think that's all. Overall, that was I think the maximum report. So next they talk about, I'm not going to go through this one, but this is where they talk about what's the optimal allocation of crypto assets in a traditional portfolio, right? 60-40 portfolio is a traditional portfolio for decades. 60% in stocks, 40% in bonds. But if you're holding 60-40 portfolio in 2022, you got killed because both were down. Generally, if the stocks are not working, bonds should go higher. In 2022, both were down. Bonds were down 18%. Where do you go if you retire in 2022? You're getting killed, right? So they talked about, ran different scenarios and looked at what are the other allocation, right? This is more for if you're talking to a traditional pension fund manager saying, hey, you should have some of these crypto assets in your portfolio because it reduces the amount of a risk as measured, return per unit of a risk as measured by Sharpe ratio, which is a pretty standard ratio used in traditional finance. So they understand what a Sharpe ratio is. And if you tell, what, add this Bitcoin 2%, 3%, or, Ethereum and a Bitcoin combination of so much percent, your Sharpe ratio is much, much higher. That opens up their eyes. Okay, now I get it. Yeah, there's a risk, but I have an equivalent amount of a return, right? So, and looking over the last few years, Sharpe ratio is much higher. But that's for the traditional investor. What I found was missing was how much of a sell pressure will be from a miners who are selling ETH to fund their operation. I didn't see any line item over there. So I will be a little cautious. I didn't Because right now they're all talking about how much value accrue, how much revenue is going to the ETH, but then there will be selling pressure on ETH also. Miners have to, or validators also have to run their operations. Sorry, they're no longer miners, but they have to run their operations, right? They have to pay for the machines and all that stuff. So there'll be little sell pressure. Maybe it is negligible. Maybe it is, maybe it is de minimis, but something they should have talked about it. I didn't see it in the report. So that's a report on Ethereum, their price. What I liked was that they've segmented different sectors in which Ethereum has a play. Then they looked at how much of Ethereum can garner that market, right? And looked at the various options, right? Base case, bull case, and bear case. You have your own case depending on how bullish, bearish you are. You come up with your own case. You have a framework. What I liked was that they have a framework. Now you can use this framework to come up with your own estimate of what you think Ethereum may be worth. It may be worth zero if you think all that is crap. Blockchains are never going to take off because they're slow. Yeah, today they are slow. But there's been work happening on proto-dank sharding and all the stuff that we talked about earlier. And, internet was slow in 1996. But today, so it's a 20-year later, could be a different one. So thought I'll share. It's a good report. I like their methodology. Numbers are numbers. You can come up with your own numbers. Can we discuss Uniswap? What do you want to talk about in Uniswap? I don't use Uniswap, but I mean, it's a DeFi exchange. Again, these are like unregulated stuff. So I don't deal in Uniswap, etc. What happens when ETH supply is reduced again in future? So that's like your stock buyback is a faster stock buyback, right? So I would be a little more cautious with the core Ethereum developers messing up with supply stuff, right? Because then, hey, then we're back to how the current system is, where a bunch of 16 Fed governors decide how much of money they want to create. And everyone in the world gets impacted by it. Why the heck those 16 people should decide? And that's one, I would say, a negative factor around Ethereum is they changed the monetary supply policy. They've changed in terms of how much of rewards are being given to validators more than once. Right? Whereas Bitcoin, maxis will say, guys, we already decided this is how it's going to be. It's not going to change it. Right? So it is predetermined. Now you can run your business based on, what the logic is. In Ethereum, these guys keep on changing it. So how is it different from fiat, right? Again, I'm giving you both sides. But yeah, if supply is reduced, that means the more stock buyback is happening. It means the lesser availability of circulating supply and upward pressure on the price. Can you take a look at Sarepta stock? I think Sarepta's either some drug got approved or they got a buyout offer, something happened.
Yeah, drug got approved. They had a one-day run of 40%, almost 30% up there. But this is, typical, right? In the biotech, volatility comes into play and people make money. So just a couple of other more companies like that, and I think South San Francisco. I'm kind of watching it, but trying to make sense of it. They still have a leg to go. Sarepta, I don't know. I'm just wondering to your take on that.
No, so I didn't even look into. I don't own biotech. I don't own any individual biotech companies because I don't understand that sector well.
Yeah.
But two, it is hit or a miss. If it works out, you're gonna double, triple, 10 times your investment.
Yeah.
And 90%, but 90% of the time you may not work. These stocks are very volatile.
That's right.
Very volatile. I mean, we have seen Biogen, right? Every time Alzheimer, in anticipation of Alzheimer drug being approved, it'll go run up 50%, and then Fed will say, we didn't see any material difference between this and the previous one, and the stock gets cut into half.
Very volatile. Yeah. It's a speculation.
It's not I mean, it is because it is an event driven. Its outcome is defined by one event.
True.
What's FDA gonna do? I don't want to buy into a stock in which one event can make or mar it. So that's why I don't own any individual biotech stocks.
So, I mean, you want to just play a biotech ETF just to get
Yeah,
some
you can
exposure?
do an ETF. IBB is there. I think XBI are there. These are two ETFs. Good liquidity among those ETFs. I mean, I think I currently have an iron fly on IBB. The damn thing is not even decaying. So, but anyway, yeah, I do, a risk-defined option trades on biotech ETF because the volatility is generally high on this. You get a decent premium.
Absolutely. True.
Yeah.
Thank you.
Cool. Did you get a chance to review Kava? I think the stock we reviewed it long, but I didn't review stock recently. But yes, I did review Kava as a product. When I was traveling, I was on the East Coast and I went in Kava and to try their food. Food was tasty, but I guess they need to figure out how to wrap it up properly because, for me it was to go. So I had that stuff wrapped in a pita bread. And when I came back to my hotel and tried to eat it, it started leaking from all places. I'm like, Chipotle people they really know how to wrap the burrito, wrap the stuff and burrito very nicely. And it became so messy, I had to use like 6, 7 napkins to clean it up. But food was tasty. So maybe we'll do Kava next week. I know I think the stock has taken off, but I didn't look at, I want to give it a few quarters before I'll become interested in picking up from a business perspective.
Hey, Vivek, one quick question. And we talked about expensive stock like Chipotle. What's your take on the stock? And one should typically invest before the split, or is it after the split, or it doesn't matter that the event might.
See, business perspective doesn't matter, but traditionally we have seen that when a split is announced, stock will have a little run up post split, right? But if you're buying a stock, when I buy a stock, I buy for next 20 years, right?
That's right.
So for me, it really doesn't matter, because I'm not going to sell it if it goes up 5%, 10% after the split. Right? So, but business side really doesn't matter, but not everything works according to logic. It's a stock market driven by individuals.
Yeah,
and we don't always behave rationally. And we see that someone trying to split a stock and now suddenly looks like, oh, the pizza has become cheaper. Instead of 4 slices, now we have 10 slices, but it's the damn same pizza. So I don't modify my thesis because it is splitting it. It does impact if you're trading options, because suddenly, if you had one option contract and split it to 10, then you have a 10 option contract, and then you pay for 10 option contracts if you're for closing the trade. Other than that, there is no other difference.
Yeah. I know you might have already discussed an SMCI split, and then somebody's mentioning.
SMCI splitting?
No. Somebody mentioned waiting for SMCI.
Oh, waiting for SMCI to split. Yeah, I think folks are waiting. Not folks, but I saw even traditional media started talking about Facebook, because now Facebook is like $500.
Yeah.
So maybe Facebook should also split. Right. So earlier we used to talk about that in your earnings, it's a beat and raise. Right? You beat your whatever the estimated analyst estimates, then you raise your guidance. Now I think should be beat, raise, and split. Every time when this happens, the stock jumps. So, all right. So what did I buy or sell? I didn't buy anything. And I took assignment on some covered calls on these of the stocks. So again, this is not a recommendation for you to sell or buy. The reason I share every week if I do stock, any buy or sell, is because we do talk about stocks. So I want to be open and transparent, and I share my portfolio at the end of every month. Right. So first session after end of every month, I'll come and share what are my top 15 holdings in my portfolio. And every week I'll share you, if there is any changes on the stock. So this week, yeah, I sold a little bit of Jumia, Magnite, and Roblox. Took assignment on the covered calls. I didn't want to defend them. It was okay to let some of the stocks go away. Ravish asks, will you be doing a session anytime soon on option selling, strike pricing and all? I did cover. You can go and, because I started this boot camp already. So it will be your checklist for opening the trades. Right? How do you pick up a strike price? How do you pick up the duration? Right? When is the best time to sell an option? So that's a checklist for opening the trades, and 8th one was checklist for closing the trade. So you can view the recording.
So Vivek, one another quick question. Just you were talking about event-based trade. Like next week, I think Micron Technology is about to get the earnings. So I picked up I sold put on Micron, picked up like $9 premium. But kind of thing it scares me, keep it open overnight and things change all of a sudden. I mean, what would you watch out for? I mean, I believe Micron is a good space with the AI happening out there, and so are other key AI players. So
See,
how do you kind of make sure this trade doesn't go against you, or how do you correct it?
See, if you invested in Micron, because I think Micron is a memory chip maker, and yeah, there'll be need for these chips, blah blah, overall AI, and
Yeah.
that's the reason why you sold it. Then
Yeah.
I think if it goes down after 1 quarter result,
Yeah.
you
Yeah.
shouldn't be afraid, because your thesis is a longer run, right?
Yeah.
But if you were doing, and I used to do this earning specific option trade, wherein I just want to harness the premium,
That's
because
right.
during the earnings time, the implied volatility
High.
on any of the stocks will be high, so you will be able to get much higher premium, right? So those are called kind of an earnings trade, and I used to do that.
Yeah.
I don't do that.
Or other way around, I mean, I think of it as like a discount to own the stock. I mean, typically,
yeah. So,
if I get assigned, I'm gonna, my cost base is low, and if I don't get assigned, I get to keep the premium. That's okay.
correct. So let's say Meta or whatever. Let's pick up Meta. Right? Because one thing is for sure, stock can go up or down. We don't know what will happen after earnings. It is
Exactly.
almost impossible. Even if we tell you the results a day in advance, you still don't know what will happen after earnings. The stock will go up or down. But one thing is sure after earnings, right? This is the Meta. Stock went up, implied volatility crashed, right? Stock went down, implied volatility crashed. Stock is up, implied volatility crashed. Stock went down, implied volatility crashed. One thing which is sure after earnings, when I say sure means 99%, is that the implied volatility will crash. You can pick up any stock, right? Stock down, IV crash. Stock down, IV crash. Stock up, IV still crash. So there are some trades that you can do to take advantage of this crash in IV.
Yeah.
Which means you then go ahead and sell options. Now, what I used to do was, and I did it for 2 years, I realized like it's like 50-50, doesn't really move the needle for portfolio. Now I do very few of them. Maybe this year I've done only 3 or 4, right? But the way I used to do it is then you wait till the last day for the stock to make all the movements, right, before earnings. Because let's say a news come in just right before earnings, and that could change the implied volatility. So I don't want to, if I am only playing for an IV crush, I would want to wait till the last day. It means if it is reporting results tomorrow, then today, near the end of the, like after 12 o'clock Pacific, that's where I'm gonna go and either sell a strangle if it is a smaller, if it is an individual stock, I'll probably sell a wide iron condor. I'll pick up a strike prices at 16 deltas, right? Or if it is a smaller value share, I might just sell an iron fly with a stock, with a strike price of where the stock is trading. Then I'll pick up a wings of maybe, whatever I'm comfortable with, to figure out what's my probability of profit showing up. And the next day morning, 6:30, when the earnings is announced and the IV crush has happened, by 6:45 or latest by 7, I close the trade. Because I was playing only for IV crush. Once that is done, I have no business to stay invested in it, because I don't have either bullish or bearish thesis.
Just take the profit and run, and that's what
Take the profit, or if it is a loss, take the loss and move on.
At the losses. Okay.
So,
Yeah, I mean,
so I have done that for like 2 years. You make profit in some, you lose on some. I realized that it's because that was like when I started my journey in options like years ago.
Yeah.
And it was good engagement tool for me to understand the mechanics and to, to understand how this works, to get engaged in the market. Nowadays, like I said, I hardly do earnings trade.
I mean, you
But
may.
I'm already engaged in market through a lot of
Yeah,
other
I
stuff.
did one, Vivek, sorry to interject. I did one with the Salesforce CRM, which really tanked at the earnings. But last week it kind of stabilized a little bit. I'm still negative on that, but one feels that you can do the earning trade, but you are more or less in the same place. So you're not made money, but just got a practice of trading up and down.
Yeah. So earnings trade generally, for me, it turned up to like a 50-50. And then I said, you know what? It's a good engagement tool. When I started my options journey, for me, it was a good learning. I don't do it often now. So that's what I would do if I'm trying to play earnings. And sometimes, like the stocks, there will be one or two stocks which will move beyond the expected, market maker movements. You can see MMM on your portfolio. But over long term, like I said, it's turned out to be 50-50. So Alfred asked, what do you explain what IV crush is? So IV crush, let's say, so implied volatility. What happens? No one knows what's going to happen in earnings, what earnings company is going to announce. So the expectations or the volatility anticipated is higher because there is uncertainty in the stock before earnings. And hence, when the IV becomes higher, the option premiums are higher. And that's the best time to sell an option. But once the earnings is announced, the cat has been revealed out of the bag. There's nothing new. There's nothing unknown about the company. So then there's a volatility which determines the uncertainty suddenly crush. And that is what is called IV crush. So every time you'll see after earnings, the IV will just get crushed. And this is one also you will see if you bought option, stock moved in your direction, and you still may lose money because you lost money because of IV crush.
Mm-hmm.
So that also will happen. Then the stock move has to be much bigger to compensate for the crush in IV. Right?
Mm-hmm. Yep.
All right. So last topic.
Vivek, one other quick question. I'm sorry, diverging. What would you do to park some short-term term cash right now? I mean, I'm looking at a couple of funds like SGov, which is like 5% treasury.
Yeah, you can buy SGov, you can buy ICSH. I mean, now you have a lot of options to get 5%, or you can just put in treasuries directly, because treasuries, you don't have to pay state and local tax.
Mm-hmm.
So
treasuries directly, what, 3 months, 6 months treasuries?
Yeah, you can buy 3 months. I mean, you can go to treasurydirect.gov, or you can buy treasuries which are being sold from in secondary market on your brokerage platform.
In TDMA trade or Schwab allows that, they have some. Oh
yeah, they'll have this. So bills are less than, I think, a year. Notes are between 2 year and 5 year, and then bonds are by more than 5 years. So let's look at recent auctions. Recent auction results. I'm not 20 most recent auctions.
Gotcha.
Come on. 4 week was paying 5.3%.
Not bad.
I mean, you don't get this is annualized in rate, right?
Of course.
So let's look at an annual 52 week, 5.11%. Right. Aditya says Wealthfront is giving 5% cash on trading account. Yeah, but then you have to pay you have to pay state and local taxes.
Yeah.
You can find CDs also, which give 5%.
But that's taxable as well.
Yeah. So T-bills, these are only federal tax, no state and local taxes. That's a advantage on this one. But yeah, there are many avenues to park the cash right now.
Super.
And
so for this T-bill, you can buy it through Schwab account, or you just have to set a separate account for treasury?
No, you can buy through Schwab also.
Okay.
There'll be a place maybe called fixed income or something.
Gotcha. Okay.
You should be able to go and see there. Yeah.
You've done that. Okay. Thank you.
Okay. Cool. So, okay, I'll not go through the why Roblox, because I mean, I had earlier mentioned why I am bearish on Roblox. And then because the company has been in business for, so how many years? 20 years, company has been in business, haven't figured out how to make any money. The business slowed down post-COVID. IPO'd in 2021, almost zero operating income since, negative operating income since IPO. And yeah, we don't have information prior to that. Then I said, I bought it at 116. Talk about timing or talk about knowing the business. But I collected $75 option premium. So my cost basis is $41, $35. I think I collected 80 cents when I sold this covered call. So eventually, whatever, $5 I lost, it's fine. I'm done with this company. So this is one reason to sell the company, guys. The business hasn't worked out. They had a tailwind in COVID, and beyond that, the results have slowed down. Right? I couldn't build conviction to hold or grow my position. It was a small position anyway. So I'm like, not really worth spending my time on this one. Sold a covered call. And I think the stock was trading at 33 or 34 when I sold this. Maybe we'll have to go back and look at it. And eventually got taken away at 35.80 cents or something. I don't have any more stock. That was the last lot I had. I'm done with Roblox. But I do have a STNE. I talked about a STNE, also StoneCo, and was selling at the money calls because I was, not too happy about what the company was doing. All right, so last stuff for today. Okay, rebalancing. And this is also dovetail into our second topic is there are ways to deconcentrate or diversify your portfolio without attracting capital gains. Something came out from my discussion with one of my CFO friends. So why I went into this topic was I saw on Bloomberg that XLK had 8 billion inflows. What the heck? This has been their inflows over the past 20 years. And how come suddenly $8 billion is filling into XLK? I know that XLK is going to reshuffle its constituency. So they're going to sell almost $10, $12 billion of Apple. And then they're going to buy $10, $12 billion of NVIDIA. But I'm like, how come suddenly 8 billion is inflow? I mean, are folks going crazy and trying to invest, hey, XLK is going to increase its holdings of NVIDIA. So now I want NVIDIA. Didn't make sense to me. Right? So that's where I started digging deeper. Like I said, the spike came right before the quarterly rebalance in which more than 10 billion will be sold to make room for NVIDIA Corp. So you might see in Apple, some weakness in Apple and some strength in NVIDIA because $10 billion of purchasing push is coming on NVIDIA stock. Okay. The huge inflow is likely a part of transaction where the fund is looking to get rid of Apple shares without incurring taxes. That is strange. If you and I have to sell our Apple shares, we have to incur taxes. Okay? But there is a trick that these funds use, right, to avoid that taxes. Okay, so for those, this is the XLK's current weighting. Apple is 22%, NVIDIA is only 6%. And because of this, XLK has been underperforming its competitor from I think S&P 500. So XLK, right, is 21.86% higher. And I don't know what's the S&P tech. That's up like almost 40% because it's got NVIDIA. So now it's going to rebalance it, move Apple lower, and increase NVIDIA stake. So, but how can they do it without incurring taxes? So this is a strange stuff called a heartbeat trade. It's an interesting read. So I do want to go through it. I mean, the article was big, and this was like 2019 article. So I'm just going to present you the summary. How do they do it? They ask any friendly investment bank, Goldman Sachs, right? JP Morgan. So if I'm an ETF issuer, in this case, XLK, I'm a XLK issuer, I'm saying, you know what? Can you put in $10 billion or $8 billion into XLK and not the cash, but give me the shares? So what they do is, let's say they got tons of shares. This H is NVIDIA. They want to sell NVIDIA, which has gone up tremendously. But if they sell it, they'll have a taxable gains. So the ETF issuer will ask the bank, hey, can you become an investor in me? Now, I'm a JP Morgan dude. I don't want to, what's in me? Why do I want to do this? It's like, hold on. I'm not asking you to invest. You invest and then you take the money out. So they say, you give me this in the same ratio, like give me some Microsoft, give me NVIDIA, give me, the other stocks that I hold in my portfolio in this same ratio, Broadcom, AMD. Give me the same ratio so that my percent is not disturbed, because I'm getting a new investment, $8 billion, $10 billion with the same ratio. And a day later, you withdraw your 10 billion. When you withdraw because you contributed stocks, when you withdraw it, I'm not going to give you cash. I'm going to give you stock. And there was a law in 1969, which Congress decreed that mutual funds, if they hand over appreciated stocks to investors, they don't have to pay taxes. They can hand it over without triggering a tax bill. So mutual fund never took advantage because the investors always wanted cash. So I think in 1980s or 1990s, ETF issuers started to take note, and they said, wow, I can in fact work with a friendly investment bank who can put in $10 billion for a day. And when they withdraw it, I'm not $10 billion. They can put in $10 billion worth of stocks for a day. And then when they want money, I'm going to give them a $10 billion worth of a stock. So it's a stock to stock exchange, no tax. And then the bank will sell that and they get their $10 billion back. And maybe some fee, who knows, those backdoor deals. So this will happen.
What
So
smart people are doing, right? We are all in retail investors are dumb money, smart people, smart money, right?
Yeah. So they will gonna, the bank is going to give them the NVIDIA, right? Without incurring any capital gains tax. So that's the interesting one. The largest ETF, S&P 500, hasn't reported taxable gain in 22 years. So this report is as of 2019. Okay, this. So it means now if you say like 2022 plus add another 5 years, S&P has appreciated a lot. Right? They never reported any taxable gain. In contrast, the traditional mutual fund run by Fidelity Investment that tracked the same index had a taxable gain in 10 of those years. So number one, mutual funds are not tax efficient. That's one reason, right?
I mean, mutual fund taxation is like, even though mutual fund makes money, right? They and are profitable, you can still get loss, right?
Yeah. And number two is, even if mutual fund don't make money, because they have swapped the constituents, you can still get hit for tax.
Yeah.
So that's why I don't like mutual funds. So what happens is, so US stock ETFs have avoided 211 billion in gains in 2018, right? Wow. And those gains are passed along to investors. So as an investor in ETF, I would want to not pay taxes and let the compound unless I need to sell the ETF, and which is what exactly the ETF structure is allowing me to do. They're just, because if they take a gains, the taxes will come out from my pocket.
Yeah.
Okay.
But that's what brokers are doing, right? I mean, my Schwab broker says it's a separately managed account where it's a mutual fund created for you with the stocks, but not a mutual fund per se.
So I'll come to that, right? So then I said, hey, if this is existing for, these ETF issuers can do it, right? And then could be something for the rich people here also, because like I said, one of my CFO friend, he told me that he has invested. He didn't tell me which financial advisor or who is a wealth manager, but he told me that he gave his lot of stock options to those guys, and those wealth manager has given him a diversified mutual fund, and he does not have to pay capital gains tax. So then I started looking into this. If you say you are a founder of a company, and because you're a founder of a company, your wealth is concentrated in a company stocks, you do want to diversify for your own personal reasons. That's why I don't feel bad if I see a filing saying founder has sold, million shares. Come on, he owed this to his family. They need to diversify.
Absolutely.
So there are a few ways to avoid capital gain tax. One is you hold it in your 401k or a non-taxable account. That may not be possible. Peter Thiel was able to do it. You may not be able to do it. Or, you sell only a small amount and, to whatever you need to diversify. But if you have a much bigger portion, you can make use of something called exchange fund. This is also known as swap fund. And this is specifically created for those, when I say rich folks, because I think these wealth managers have some minimum limit. I don't know what the limit is. Maybe 500K, maybe $1 million, maybe 250K, maybe 200K. So if you give,
and there's the so-called accredited investors only kind of thing, private equity, you're talking about all those
no,
kind of
this is not
options?
private equity. So what happens is, basically, this is a process where exchanges a concentrated position for a shares in exchange fund, and this is called a stock swap. So it's not a stock sale. So it doesn't trigger capital gains tax. But there are a few things in it that you need to remember. You need to be aware of. So what happens, one key benefit is the investor can defer capital gains on the sale of the concentrated stock because it is structured as a swap rather than a sale. So let's say if I'm a founder of XYZ company and I got 10 million shares of XYZ company, I can give those 5 million shares to a wealth manager, and whatever, let's say that is worth 20 million today. So that wealth manager will give me a mutual fund, which will basically be diverse, because my main idea is to diversify my portfolio. He might give me S&P 500 equivalent fund that they may have created for this purpose, which means I got exposure to 500 companies instead of just one company, which then it is structured as a swap. So me giving my shares doesn't trigger capital gains, but I have to hold this for next 7 years.
7 years.
Which is fine because I'm a long-term investor. I anyway wanted to diversify my portfolio, but I'm sure on top of whatever the S&P is charging, the mutual fund or whatever, the wealth manager will have their own fee and all that. So we're not talking about fee here because every fund manager or every wealth manager may have a different fee. But you got a 7-year holding period. During the holding period, you will receive dividend or other distributions from an exchange fund. And the value will increase or decrease depending on market conditions, right? Say if I buy equivalent of SPY, it depends on how the market is performing. So after the 7-year holding period is over, the exchange fund, the fund will distribute whatever those individual stocks which were in the basket to me, right? And again, these may vary depending on what the market, etc. is. So this is a useful tool for investors who are heavily concentrated in single stock and want to diversify holdings without triggering capital gains taxes. So then I started to Google it. I found something from Morgan Stanley called exchange funds. Now, they have explained it in much more detail around what you can do, what's the tax deferred, how it is growth and all that. But net, that's what it is. This is something which was new. I learned. I think they have a minimum of maybe 500K or something. And then, range from 500K to $1 million. So you need to give them a 500K worth of stocks to participate in this. So that's what I say. It's a rich people way to avoid capital gains tax.
Wow. Okay.
If you're not that rich, Only option is, hey guys, you have to sell your stocks and then buy S&P 500. That means you have to, it triggers your capital gains tax.
So what
And
if
Vivek, is there
if they sell it before 7 years? Is that a bigger tax penalty or something else with that?
I don't know. I didn't get into the details of it, but I
Is
thought
it-
I'll at least trigger this spark in
Yeah.
your mind. If you want to utilize this, go ahead and look for exchange funds, maybe a swap funds. And it says what fee, Morgan Stanley has a fee ranging up to 0.95 plus one-time fee of 1.5%. So you can run those calculations too, and then say, maybe should I pay capital gains tax? Because a long-term capital gains tax, maybe should I pay 15%? Then, I don't have to hold it for 7 years. I can do whatever I want to do because you have to hold for 7 years. You account for the fee. You can make that decision. But I thought I'll at least share this. This is something new that I got to know after my discussion with my friend. I'm like, how come he's able to, what is he saying to me that he's been, he gave some shares to someone and he got some fund and he doesn't have to pay capital gains. So that's all. When I got to know this ETF stuff, I started researching about this. Then I realized this is actually true. He was not, kidding with me.
So Vivek, is there a way to convert existing S&P 500 mutual funds to SPY ETFs without actually liquidating them into a cash and triggering a tax event?
I don't know, maybe talk to whoever is mutual fund if they have something called exchange fund, and otherwise I'm not aware of this thing.
Okay.
Yeah, like I said, I only got to research this week, so I'm pretty new to this. And I mean, I don't have a minimum 500K of a concentrated position, so I won't have to use this. But if one of you have, concentrated portfolio, rather than trying to sell and incur capital gains tax, I mean, do your own calculations, but there is a way. That's all I wanted to share.
Yeah, I mean, right now the brokerage are offering so-called SMAs, separately managed accounts. They say that you're creating different buckets, like different 6, 7, 8 mutual funds. You're splitting money, large cap, small cap. But instead of mutual fund, you owning individual stocks, which can do tax loss harvesting. But I does not compare with this particular situation which you shared. That swapping is definitely advantageous for somebody who's a founder.
All right, I think that's it for today. Thank you everyone for joining in. Maybe I can be around for another 5 minutes.
Vivekji, I have a question on my AVGO.
Yeah, let's talk about, you had some question on one of your trade.
Yeah, just one second. What happened is on around June first week, I bought AVGO. Sorry, not bought. I already have AVGO stocks. So what I did, like I have more than 100, and that one because I'm not earning any money. So after an after our class, I'm learning about the selling, right? So I thought let's sell some stocks to make money. So I went and tried last month once, and when it around 2,300 or something, when it became around because of the changes, right? When I got some 50% profit or something, 50%, I taken out. So this time I tried again. And when I tried this time, the price was around 1350 or 1380 something. And that I took the July as a month actually, because it's June first week. And I taken the 9 delta, which is $1,600 that time. So I thought that's a safe bet. I know to just go with that one because 9 is very low. So when year came and near year, it's around 1480, something like that. That scared me, but the way I thought it may be, because it's already priced in, ER is already priced in. So why worry? Because if it goes down, 90%, it should go down if the year sounds like anything bad comes. But it came out some very good news of 10, I don't know, it's a 10 split, 10 to 1, like you said, is a good or not, it's the same thing. But people are excited and they jumped on it. Now, the next day, that after market stuff, that it went to almost 1,700 plus. So my call was around 1,600 call.
Uh-huh.
So the next day I was kind of that evening was kind of a lot tension on that because it's goes one is taken away, and second is if I want to sell, it will be huge amount. So the next day it was opened around 1720 something like that,
Mhm.
and but it came down around 1660. That's the time I thought, okay, let's sell it, and I taken that $10,000 loss. So if I taken the same day, that means before year, I'm at a $4,000 loss because it's gone from
But
I
it's
don't
not
know,
a loss. It's like your stock is appreciated, right?
the stock appreciated,
Yeah. So
but
it's
we're not
so
selling
overall,
it.
you're still better position than where you were when you did the trade.
Yeah,
You only lost the opportunity to make even more money. Not you did not have a loss on your portfolio. Let's make that clear. Because when you did the trade, stock was at whatever 1300,
yeah,
and
1330 something like
right,
that.
and your strike price was
1600 or
1600,
uh-huh.
and it means your gains are capped at 1600. You're not going to make any more profit beyond 1600, right? So if a stock has now gone to 1700, yeah, your gain is only limited up to 1600. So if you sell your stock and close your option, your eventual portfolio is still higher than where you started at.
Yeah, that's true. But thing is, when we are that is one a good angle. Thank you for that. But same thing is if you see from other side of the coin, because we are trying to make income, right? But the purpose is just to make income. But it is the way it's shown I got 1700, but it's showing 4000 loss. It's appreciated. You're right. But thing we are not selling, right? The purpose is not selling the stock. We are trying to make money as income through the options. So from there, I was kind of feeling lost, but I don't know that. To avoid that, I added my analysis that screwed up further. So is it something? What is the things which I should have done?
So,
What is
so first of all, because it went so high, I mean, we still have a time for July, right? So for any of the stocks, and I think we also talked about when we talk about different flavors of covered call, right? When it comes to individual stocks that I want to hold for my dear life, I don't sell a call. I always sell a call spread, right? Especially the stocks which are momentum stocks. That's a lesson we learned in 2021, because sometimes the stocks become crazy. So in this case, let's say you sold at 1600, maybe instead of 1600, could have sold 1600 and 1700 or 1600, 1800 call spread. That the premium that you received would be reduced by a little bit. But what if Broadcom becomes like next NVIDIA? You don't want to be out of Broadcom if it becomes next NVIDIA and goes up like 400%, 800%. So that's why on these individual momentum stocks, I would rather go and sell $50 wide, $100 wide call spread, sacrifice some of a premium, but give me a chance that if it becomes NVIDIA, if it becomes GameStop, I'm still in it. Okay, so that's one thing for future, right?
okay.
If the stocks that you don't want to get, or let's say if you have a more than 100, then maybe, yeah, man, 100 will be taken away, but I have another 100 or another 200 that will continue to benefit. If I have only 100, then if I were in your place, then I would rather have sold a call spread, because today it is AI. Everyone is going crazy on AI. And then I don't want to be, cut my profit at 1600. I want to be in the game. Sure, I'm going to make profit from 1300 to 1600. Then I'm not going to make from 1600 to 1700. But if it continues to go up to 2000, man, I'm back in. Right. So,
Yeah.
so that's the stuff, first stuff, when you're doing a trade. Number two is you could have, I think someone mentioned that, could you have rolled? You could have rolled it to next expiration, because then the thought process would be, oh man, it's went up, what, 12% after earnings? Just because it did a split, probably it'll gonna come down. I mean, you still have time for 14 July. And now if you look at it, it's already come down at 1638.
But they will take it out anytime. No,
No. So that's why.
I
Look
have
at
to
look at
scale.
session number 6. You might have a lot of extrinsic value still remaining in it. If you still have, so your strike was what, 1600, right?
Yes, sir. That's right.
1600
July, yes.
July, 1600. 16, there you go, 1600. You got a $44 of extrinsic value remaining in it. Who would want to just let go $44?
Oh, man.
So there is almost no chance of, I mean, let me put, there's 99%, 99.9% you won't get assigned until this extrinsic value becomes very less, maybe $1, $2. Or if there's a dividend coming up, then you have to figure out, like I explained in the video, whether you have an early chance of early assignment or not. Here you don't even have it. You have a time, you can wait.
That means extrinsic value need to be negligible. Then only they'll take it out.
See, here's my thing. If
Uh-huh.
I am a call holder, look from my perspective.
Okay.
If I'm a call holder, if I exercise my call, right, I am giving up this $44 of extrinsic value. Whatever the extrinsic value, I have to give up. Right? I won't do that until this decays because I want to be in the game. What if this continues to go higher?
Yeah,
So
that's the problem. That is where I also felt problem like Vivek.
Yeah.
Because if it goes further up, if it goes to 1800, 1900 again, so I will be kind of losing that all
yeah,
opportunity.
so I mean, your gains are capped at 1600. So first of all, I think when you did a trade, like I said, on momentum stocks, sacrifice some initial premium, do a call spread instead of doing a call. Or if you're more than 100, then that's fine because then you will still be in the game.
Okay.
Ravish says that there is a dividend coming up. So dividend coming up will change this calculation. Then you have to check how much is the amount of dividend. I mean, like I said earlier, I closed a lot of my QQQ short call trades because the extrinsic value was less than the dividend. So I will definitely get assigned. So you need to figure out how much is the dividend coming up, compare it with the extrinsic value, then determine do you have a risk of assignment or not. If you don't have a risk of assignment, then you could still be in the game. What you could have done, right, is maybe roll it out, collect more premium, and then buy a call at maybe 1800 to protect, or to, if it goes crazy, use that premium, that additional premium that you collected to maybe buy a long call to convert just a short call into a call spread. That was another thing you could have done.
Sorry, I lost it. That means rolling. Rolling means here.
Rolling means go to the next expiration.
Month, again, August month.
Yeah, rolling means go to the next expiration means, let's say if I were to roll it right now, I'll buy it for this. I'll go to August and let's say 1600.
Oh, same price, same strike price.
Yeah. So what I collected $33 of premium, right? Now I'm gonna use the $33 of premium to buy this long call. So at the end of the day, I just get $1 and now I have a call spread, right? It's 1890. I could rather do instead of 1890 call spread. If you want to do only till 1800, you might have to pay a little bit, but that may be worth paying it. And you pay $20 and still be in the game. And if the stock continues to go higher more than 1800, man, you're back. So these are some options you could have done.
Yeah, I was thinking to call you, but you are on vacation, so I was just kind of avoided. Yeah, that I was a little bit tense. One thing I thought like another, it will take away any time. So I take the 10,000 last year.
No, yeah. So perfectly fine. I mean, that's why I spent so much time on this assignment and exercise process. Hey, it's a scary phenomenon if you don't understand how exactly it works. So that's why, maybe go and rewatch the video in terms of how to figure out if your trade is at a risk of assignment or not. And if you are selling a call, you have to know when the dividend is coming up, because that will.
Yeah, these 2 points I considered like Sachin mentioned and you mentioned that those things. But only thing is like now that something is in me kind of a fear mongering kind of thing, what our emotion saying that oh, this will go away because extrinsic value can go, like, because it's a high volatility time, right? Because is earning time, and that can change drastically
Yeah,
because it changes. So with that kind of feeling, like, I guess I have to sacrifice that.
yeah. See, good thing is your portfolio is higher than where you started. Yeah, you could right now you could have made another $40, but if that was the case, I mean, if you knew it, you wouldn't have done it. I mean, for me, that's why I've like over years selling options has worked out because I don't have a crystal ball.
Yeah.
Such
Yeah.
as I generally have seen, if you sell puts, it can get assigned within 30 days. If you sell calls, it date of expiration. No, this is no such rule. It's dependent on extrinsic value. Now, the call is also got a dividend, which adds another twist to assignment. But if you sell put, maybe it got assigned because the stock would have fallen down and the extrinsic value would have decayed. And there may be a very little extrinsic value left, and hence you got assigned. I mean, it has happened with me. Sometimes I got it, like I said, I got assigned 4 weeks, but that was a dividend case. I forgot to track dividend on that stock.
That is like the golden rule here. It is if the extrinsic value need to be lower, and that means one is the dividend, the one thing. Second thing, extrinsic value has to be kind of first need to be low. If it is around less than the value.
So it's not a scientific rule, but let's say a sane person, let's say if I'm crazy, if I'm the call buyer, I could call up my broker and say, I want to exercise it today. Whatever reason, I want my stock in my portfolio, right? In that case, someone will get assigned. But generally, if you're a rational person, you would not do it, and you would not give up that extrinsic value. So I've not seen any assignments wherein, at least in my account, wherein, hey, we still have a big extrinsic value and I got assigned. I got the surprise because of dividend though.
Okay. And
Cool.
another thing, I have one more trade, which is I'm kind of facing some issue on the PayPal. Again,
So Chandra, I need to go. So can we discuss that next one? Or maybe why don't you ping me on the Slack? Let's put in the Slack channel, then I can respond.
Yeah, sure. I can have that.
Cool. Sorry, I have to go.
No problem. Thank you.
Okay.
Yeah. Thank you.
All right, guys, thank you very much for joining today. And we'll talk. We're going to talk on Wednesday on Options Bootcamp, the next session on Options Bootcamp. This is where we talk the details of options. And we'll meet again next Saturday to talk about generally what happens in the market.
Wednesday, do you send the meetup invite?
It will be on the meetup. Yeah, I'll schedule the meetup.
What time is that, Wednesday?
6 p.m. It's
6 p.m.
because we have folks from East Coast also. So we from 6 to 8, East Coast as well as West Coast. So that's time works best. It's 6 to 8. I'll set it up on the meetup. So if you are on a meetup, you'll get that. And if any localites looks like, if I can get up at 5 a.m., I can actually go and hike Mission Peak. If anyone is interested, maybe on Saturday morning, we can do a Mission Peak and then come back for the session. I was also scared, but I think I got up at 5 and I was able to do it today. Sachin says he's interested. Okay, so let's plan up. Sachin, are you on Slack?
Yeah, I'm interested too.
Okay, maybe we can plan up on Slack and figure out some weekend we can go and do early morning. But so today my friends were saying, can you not do it live from Mission Peak? I'm like, no, that's not how it works. Cool, guys. Thank you very much for joining today. We'll talk again on Wednesday and on next Saturday. Bye-bye.
Thanks, Vivek.
Alrighty.